Welcome to another week of AusBiz. Excited to be back as always here for our Equity Mates show. My name is Bryce and as always I'm joined by my equity buddy Ren. How's it going?
I'm very good, Bryce. We are right in the middle of reporting season. There's so much to talk about. Great time to be in the content business.
Great time for content.
But we've spoken about it a little bit on the show, and we thought this week we would bring some experts in to help us unpack what's going on, hear from people a little bit smarter than us. And so this week, if you're joining us throughout the week, you'll hear from a number of experts, get their view on reporting season. And we've got an exciting guest to kick off our week today.
Absolutely. It is our pleasure to welcome to Equity Mates Chris Conway, who is Executive Director and Chief Operating Officer at Marcus today. Chris, welcome to Equity Mates.
Thanks for having me, guys. A bit of a generous introduction there. You said people smarter than you. I don't know whether you've hit the mark on that.
Well, we're going to soon find out, Chris. So, but thank you for joining us. We're looking forward to the next 15 minutes or so. And as Alex said, going to focus on all things reporting. So we'll kick off. For a beginner investor watching who's just starting their journey, how do you approach reporting season, and what are some of the key things that you're looking for at Marcus today when it comes to company reports and earnings calls?
Yeah, so firstly to the question about a beginner investor through reporting season, my advice very humbly would be, don't try and guess at things, don't try and predict results. And really don't try and be a hero. I've been in this game for 15 years now, and I've seen many a seasoned investor carried out on a stretcher during reporting season because some crazy things have happened that they just weren't expecting and certainly couldn't predict and certainly couldn't price. So my advice to those who are new to the market is if you do have a long-term view, it's fine to hold your companies over reporting season. Of course, if a company reports well, then that's fantastic, great. Obviously, you just keep holding it. If it doesn't report well, and everyone will be faced with this at some point in time, is just go back to the original thesis of the investment. If the original thesis still stacks up, despite maybe the share price falling 10 or 15%, then I would suggest that you hold it because you bought that company with a long-term view. One bad result doesn't necessarily kill it. So don't panic sell. Only sell really if the thesis has changed. But I think the most important thing for beginner investors is understanding the difference between results, which can look very good, versus expectations. So I have heard some new investors in the past, they'll have a company, they'll love it, it will seemingly report very well, it's grown revenue and it's grown profits and all those sorts of things, but the share price is down 15% on the day of results. And that's because as good as the results were, they simply didn't meet the expectations, the very lofty expectations that the market had. And I would say figuring that out as a relative newbie to the market can be incredibly difficult. So in that vein, to answer the second part of the question is, what am I looking for this result season? I'm certainly looking for the numbers. I do want to see good numbers. I want to see a company meeting those expectations. But I think a lot of this reporting season, guys, is about the outlook statement and, whether or not the results that we're seeing are repeatable. Because we must remember the lockdown started in June last year. So that's the period that we're cycling. For a lot of these companies, revenues and sales and profits would have fallen off a cliff as lockdowns kicked in. And so we're cycling that. So it's very good. It's very easy to look good now because it's gone from being a terrible period to being a better period. But the question is, can those results be repeated in the coming periods? And I think that's what investors really need to pay attention to.
I think there's some great pieces of advice there for beginner investors, well, really for all investors. So if we take it from the general in terms of what you look for every reporting season to the specific in terms of what you're seeing this reporting season, we're a bit over a week into company results. What are some of your key takeaways so far?
Yeah, so I would say results, Alec, have been solid, not spectacular. I certainly don't think it'll be like US earnings season where we saw almost 70% of companies beating expectations. And the results so far aren't even as good, this is locally, aren't even as good as what we saw in February, the last reporting season, which was one of the best reporting seasons for a while. Similar to the US, financials have done well, and I think that will continue to be the case. Insurers, they were a big standout. We'll probably talk about them in just a moment. But just up until the end of last week, and these numbers are courtesy of Macquarie, there were more beats, 10, than misses, which was 6. But as I said, those results weren't as good as what we've seen even just in the previous reporting season. And so far, we've seen more downgrades, numbering 8, than upgrades 4. That's to FY22 earnings. So, like I said, solid so far, not spectacular, and I think that will carry through for the rest of the season.
So, Chris, investors always like positive surprises when it comes to reporting season. So, have you seen any early surprises, both in the numbers or thematics that are emerging at this stage in reporting season?
Yes, Bryce. As I was just saying, the insurers in particular are ones that have stood out. More about the as much as the numbers, but the share price reactions as well, and again how the numbers came in versus expectations. So that's the key here. Expectations were quite low for the insurers, but it's because they were so low and they've largely beat that the share prices have done well. Mind you, a lot of the insurers have put their premiums up fairly significantly. QBE, for example, I think the average increase in premiums was 10%. So when you jack your prices up 10%, you'd probably want to be getting some pretty good results because you're likely to lose some customers out the back door as less people take up insurance. So yeah, the insurers in general, but the other one that really stood out to me was Telstra. And again, it's a product of previous expectations. So Telstra has been somewhat of a disappointment for quite some time, probably not the last two periods. But their results, I must say, were pretty good. Everything seems to be moving in the right direction. So from the cost-cutting exercise, they've shaved something like $2.3 billion out of the cost since 2016. Mind you, they've fired 8,300 long-term employees as well. So again, when you're cutting your workforce significantly, you'd want to be making a massive difference to the bottom line. But there's some growth or some steadiness starting to come back in mobile. Margins are improving. They've got the Foxtel investment that they have that might IPO soon, and they're expanding into medtech as well. So the results were solid, and there's a few exciting things potentially happening as well with Telstra, which isn't something we've been able to say for quite some time.
Yeah, I think for as long as Bryce and I have been investors, the Telstra turnaround has just been maybe a quarter away. So it's great to see it's finally coming. Well, hopefully
maybe.
It's finally coming.
Yeah.
So that's some companies that surprised on the upside. There have also been some disappointments. What are some of the disappointing results that have caught your eyes so far?
Yeah, so there's been two that stood out, and I would say in both of these examples, it's a product of the success that these companies have had, or what they experienced heading into results. The first one was Mineral Resources. So these guys missed on their profit line and their revenue line, but again, it had been so hot because these guys are exposed to two of the hottest commodities that we've seen over the last 12 months in iron ore and lithium. So the expectations, like the share price, were through the roof. And they did miss. It wasn't a massive miss, and the share price pulled back a little bit on the day. It has sort of steadied, though, around the $60 level. But again, it was slightly disappointing. And GMG, I must profess, this is a company that I like a lot and have ridden it since the March lows. It was trading down around 16 at the March lows last year and was about $24 heading into results. Now sits about 22, so it's come off about 10%. They actually beat on profit, but I think because they didn't update their expected distribution, that disappointed the market a little bit. Obviously some investors wanting them to hand back more of that capital that they've built up. But like I said, I love this company. I think the pullback is a buying opportunity. I love the fact that these guys are plugged into that big box retail with the likes of Amazon and whatnot, and the e-commerce side of things. So. That was one that did disappoint, but like I said, I think it provides an opportunity.
Yeah, Chris, I think those two companies are great examples of what you were talking about at the start of this episode about, think long term and, think about, does your thesis still hold? Because Mineral Resources, you zoom out on that chart and it is a phenomenal story. And similarly, Goodman Group is exposed to so many great trends in terms of the move to e-commerce and, one of their biggest customers is Amazon and all of that. So I think two stocks that may have disappointed in the short term, but long-term investors are probably sticking pretty fast to them.
Yeah, well, I certainly am, and I totally agree 100%. I think, these stocks, as you say, that are good long-term stories. All you're really hoping for is an opportunity to buy at a depressed price, because no one really likes chasing prices. I think we do all understand that if you want exceptional growth, you have to pay an exceptional price. But as human beings, we are reluctant to do it. So anytime you are presented an opportunity to buy a great company with a pullback in the share price, I think that's basically heaven for investors. So yeah, like I said, I'll be having a crack at these two, I would have thought as well.
So Chris, last week we had Henry Jennings from Marcus Today come on and talk about the Holy Trinity being,
Yep.
buybacks and special dividends and huge payouts. Are there any companies that you're interested in, going forward in reporting season, or do you have your equivalent of the Holy Trinity that you're looking out for?
Not quite as sophisticated as Henry's Holy Trinity, I must admit, but there were two sectors that I was very interested in heading into the season, and it hasn't changed. And those two sectors were materials, obviously the big boys, the big iron ore miners. We've got BHP tomorrow, will make for interesting reading, and of course Fortescue at the end of the month. And the size of the dividends and the buybacks and the specials and all those sorts of things. So still interested in seeing those. But the other sector that I was particularly interested in seeing, and this is more about the consumer and understanding where the consumer sits in all of this as we plunge back into, or plunge further into, in some cases, lockdowns once again. And that was the consumer discretionary space. I, in particular, like a company like ARB, I believe they're tomorrow as well. Also want to see Supercheap, Burson Auto Parts, Lovisa, obviously the jewelry maker, Domino's Pizza. A lot of them have performed very well, but it's really about understanding, as I said, where the consumer sits in all this, how they're feeling, and having a really good look at the outlook statements for those companies, again, to see whether or not these companies believe that their results are repeatable in future periods. That's really the key to all of it is, can these guys cycle through and continue to put up really strong numbers and support their share prices? So, consumer discretionary for me, and those specific names that I was just talking to, very, very interested in seeing what those numbers look like, and as I say, the outlook statements as well.
Yeah, it will be fascinating to see some of those results as they come through. Now, Chris, one thing that Marcus Today does, and if people want to check out Marcus Today, they can head over to the website and see a lot of the content that you guys are producing around reporting season. But one particular thing you do is a buy, hold or sell for companies, and as more information comes to light, you're changing those recommendations, and there's never more information than at this time of year in reporting season. So while we have you on, we've got to ask, with all the information that's come out so far, has Marcus Today put out any more buy recommendations based on the results we're seeing from this reporting season?
Not as of yet, but there's certainly some things on the agenda that I'm happy to talk to. So first and foremost, one that we sold out of was James Hardie. This is one that I sold out of. Now, I still really like the company. It's trading about $51 at the moment. A lot of brokers have target prices up towards $59, $60. It just looks overextended, and I tend to be slightly shorter term, not day trading by any stretch of the imagination, but not quite as long term as, say, Henry and Marcus. So this was one that it reported well, had run really, really hard, just looks a bit overextended, and I sold out of it just looking to lock in profits. But again, if it pulls back to a price that's appropriate, then I would be happy to have another go at it and add it back. But one that I'm certainly looking to buy, and it was one that reported results today, was BlueScope Steel. Now, again, it was only a couple of weeks ago that these guys preempted the market with what their results were going to look like. So the results themselves today weren't really a revelation at all. They were basically in line with what they said a couple of weeks ago. The few moving parts that changed the thesis, again, as we were talking about earlier, is that they declared a special dividend of 19 cents. They're doing a buyback of up to $500 million. And they also provided some pretty strong first half guidance with their underlying EBIT expected to be in the 1.8 to 2 billion range, which is a pretty lofty expectation. Again, top right on the chart, really strong. Would love to see a bit of a pullback in this one. But if that pullback does come, this is one that I'll be like a rat up a drain pipe, boys. I'll be all over it. So we'll be looking to fill my boots with that.
Love it, Chris. Well, unfortunately, we have run out of time, but I think, you've started with some really good advice there for beginner investors on how to approach or think about approaching reporting season. It can be a pretty daunting and scary time for newbie investors as they see their portfolio, react to expectations So very much appreciate you joining us today, and we'll certainly be keeping an eye on some of the stocks you mentioned there. So look, we really appreciate your time.
Thanks, guys. Thanks for having me, and hopefully we can do it again soon sometime. Cheers.
Absolutely. Well, that does bring us to the end of another episode here at Equity Mates. If you'd like more info on what we're doing, head to equitymates.com. But otherwise, Ren, a week of experts.
That's right. We've got a week of experts breaking down reporting season, but also approaching it from a number of different angles. We've got momentum investors, we've got some technical traders. So we should have a week full of different perspectives. So join us, same time, same place, all through the week to hear these different views.